where we teach you and show you the successful real estate lifestyle. And we've got a great topic that I know is of interest to everyone with regard to financing on apartment loans, and particularly on large apartments and all kinds of apartments. There's non-recourse loans, which everybody's always interested in. Non-recourse means there's no personal guarantee. We're going to be talking about that today. And I've brought on an expert in the field. I introduced him a moment ago, but on a particular part of the finance sector about HUD multifamily loans. And I think you're going to find this fascinating if you're not familiar with this. Matter of fact, a lot of people are not familiar with it, a lot of the nuances and what you really can do here, because this is what you're really playing for. When you hear about these loan products, you're going to get really, really excited no matter where you are in the multifamily space. So with that, let me introduce you to our guest expert today, Mr. Blake Janover. He's with Janover Ventures, and certainly in the area of HUD he covers, well, he's explain for himself here in just a moment, the whole gamut of commercial and multifamily financing. You know, there's so many different products depending on where you are, small versus large, rehab versus stable, purchase versus refi. Refi is a fascinating area, and it is an area that Blake has immersed himself in on a daily basis. And so I'm going to be interviewing him about particularly the HUD loans. We may get up on some other, but talk about the HUD. And also it'll give you a chance to submit your questions. And at any point you can do that through the chat box on your webinar screen. You can field a question, and I will be forwarding those on to Blake. So with that, Blake, let me welcome you to Greenlight REI.
Lance, thank you for having me. I really appreciate it.
Wanting to do this, and can you hear me okay?
Yep, I hear you well.
Okay, perfect. You know, when looking at your web pages and all the stuff you're doing, it really reminds me of finance.
You're breaking up something.
Uh-oh,
You're breaking up something fierce there, Lance.
Okay, let me try this. Hang on, Blake. Is that any better?
It is.
All right, I'm going to hold my mouth just right. Can you hear me now? Okay.
Yeah, gotcha.
Okay. Well, let me repeat so everyone can hear that, because I was breaking up. And the world of multifamily financing is really fascinating. There's so many different products, so many different approaches to it, so many different ways for you to profit, whether it's small, large apartments, purchase, refi, stable, rehab. It's a fascinating field, and the good news is people like Blake Janover are experts on it, and all you got to need to do is go to the expert like Blake, and they can find the way for you. Now, today's topic is going to be on the HUD multifamily loans, and like I was saying up front, I want you to be able to submit your questions at any point. Use the chat box on your GoToWebinar screen, and I will relay the questions on to Blake. So with that, let me shut up for a little bit here. Welcome, Blake, again. So Blake, real quick, give everyone your background, how you got into this area of financing, and exactly what Janover Ventures does.
Sure. It would be my pleasure. I'll try to keep it brief so as to not be too self-indulgent, but I've got about a decade and a half of experience in multifamily and commercial real estate capital markets and financing. I started late or in the middle of the last cycle, the last real estate cycle, say sometime around 2003 or so. And I've been in the business in one level of the capital stack or another for the last 15 years. Right now we have the most robust presence on the internet for anything that has to do with multifamily financing. So if you're Googling around and you're looking up multifamily loans or small apartment loans or FHA insured multifamily debt on Google, you'll undoubtedly land on one of our websites. And we have a whole team that's dedicated to advisory, analysis, and execution of multifamily and other commercial real estate loans, generally from $1 million and up. But we also have built some joint ventures over the years with some really robust non-bank and bank lenders, so that we could help service kind of everybody that we get to touch online.
And Blake, so actually, and I'm going to ask you a question. Having you saying that, from your experience, when you're talking to people, would you say there's more of a vast lack of knowledge of all the financing products out there, or most people that are contacting you well informed?
You know, it's pretty crazy, the lack of organized and clear information that's out there and that people have. So ahead of the call, you and I were just having some small talk, I suppose, and you asked me a question like this, and my answer was that there are, you'd be surprised, especially when it comes to, definitely when it comes to Fannie and Freddie products, absolutely when it comes to FHA, and FHA and HUD is really kind of interchangeable, right? It's the same thing. But there are middle market, when I say middle market, you're talking about guys that have multifamily portfolios, let's say between 500 units and 2,500 units, something in that space. There are super sophisticated investors and real estate companies out there that don't know that you can get FHA insured multifamily debt for a market rate apartment building. They think it's only for affordable. Or there's small investors that have built portfolios of 50 to 500 units that have no idea that they can get levered up 80%, 30-year fixed and fully amortizing Fannie Mae debt, all non-recourse, of course. So I find that even the most sophisticated shops and borrowers, guys that I talk to that have 9-figure balance sheets, still have a lot to learn. And it's not that I'm particularly smart, it's that I've allowed myself to be stupid at so many other things that I happen to know this space really well.
Very, very good. So that's why, you know, it's great that you're here. So let's talk about this. I want to drill down. And by the way, guys, taking what Blake just said. So if you're feeling like kind of the newbie in the space here, welcome to the club, because it's an amazing space, and most people don't even really appreciate all the capabilities. That's why we have Blake here. So I want to drill down to HUD as we talk about Blake and the HUD products. When I talk about HUD, I think of the 221D, the 223, and so if you could, I'll let you're the expert on it, kind of drive, but can you start off with maybe a quick primer on these HUD multifamily loan products and what they mean for multifamily investors?
Sure. So there's some basics. There's the 221D4, and this is the section in which the rule is written, right? So there's HUD 221D4, or FHA 221D4 insured debt, and that's for new construction of multifamily properties or the substantial rehabilitation of multifamily property. There's all kinds of nuances that go with this that we can discuss later, or perhaps in another podcast, because I assure you, I could take 20 minutes explaining it. We do happen to have some really cool explainer videos though, so I'll share that with you later, that maybe you can include in the notes. But there's 221D4 for ground up construction and substantial rehab. There's 223F for purchasing multifamily or for purchasing an apartment building, or for recapitalizing or refinancing an existing one. There's the 223A7, which is if you want to essentially redo existing HUD debt. And then there's 232, which we probably don't want to go into, which is healthcare oriented for senior living properties with services like Alzheimer's care and things like that.
All right. So that's actually, there's more than there than I realized. And so with these loans, you're talking about for the purchase or refinance, either one, correct?
That's right.
And let's just talk about the 221D4 and the 223F just for the moment, because I'm the ones I'm certainly most familiar with. And first of all, we're saying they're non-recourse. For anyone that's not familiar, first of all, just real quickly, what does non-recourse mean?
Well, I'm gonna add a caveat to that, or a carve out, if you will. So recourse is a loan that's personally guaranteed. You sign something that's called a PG, a personal guarantee. Usually, it's if you have partners, it's jointly and severally, and it says whatever happens, you're on the hook personally. We are. If something goes wrong, you default on the loan. We're coming for you, your house, your car, your kids, your clothes, your shoes, silverware. Non-recourse debt says that the only recourse a lender has if something goes awry, as it did in the last cycle, which it seems lots of people have forgotten about, their only collateral is the property, the furniture, fixtures, and equipment, the leases, so on and so forth. And non-recourse loans are all generally made in what's called an SPE or an SAE. These are acronyms for SPE is special purpose entity, SAE is single asset entity, but it all means the same thing. It's an LLC generally that owns that property and nothing else, and it's a shield against the borrower from outside liability. Now, what I'm going to add to this that you didn't ask me, but I'm sure it's coming down the pike, is that most non-recourse loans are subject to carve-outs. And sometimes these carve-outs are called bad boy carve-outs. But you can essentially consider this as a caveat, or quite literally a carve-out. And the story of the carve-outs are, this loan is non-recourse except for in the case of, and we like, the industry term is bad boy because it's, if you've been a bad boy or a girl, what would a bad child do? Well, in the case of borrowing X millions of dollars in debt, they may materially misrepresent financial statements, commit fraud, not pay taxes, things like that. So when there's intentional and malicious misconduct or negligence, there is the possibility of recourse being triggered. And this is written into the loan documents, and this is why it's very important to have a super experienced attorney representing you. I am not an attorney, but you'll find that most non-recourse loans, pretty much all of them, and we could talk about exceptions, have carve-outs for misbehaviors.
Yeah, fair enough. So yeah, just be straight up. Be straight up. So there's, I think the bad boy is the best description of it, or bad girl, bad child. You got to be straight up, not represent everything that you've got as it stands. All right, so obviously, the non-recourse is obviously very attractive by, like you say, shielding us from coming after our personal assets in the event of default. On these HUD loans, talk some about the amortization schedule and the balloon term. This is one of the unique aspects of it is the long. Well, basically, the term is the term. Can you explain that, please, Blake?
Yes. So I'll hit these 3 bullet points. So balloon terms, HUD debt isn't really subject to that. So you'll see most long-term multifamily debt is kind of balloon-oriented debt. So they're mosely 10-year terms, 30-year amortizations, or if you go to that's with an agency or some kind of securitized vehicle. But if you're going to a small bank or a credit union, you might get 5-year fixed rate debt on a 20-year amortization. So those are generally balloon notes. HUD is self-amortizing debt. The term of the loan and the amortization are coterminous. Your payment on day one is the same as your payment on the last day of the last year of the loan, at which point the loan is paid in full. The exception to that rule would be HUD 221D4. So HUD 221D4 debt is construction debt, and those loans are fixed at 2 to 3 years interest only during the construction period, and then they convert to fixed and fully amortizing for the balance of the loan, which is an additional 40 years, which is a really cool feature of HUD 221d4 insured debt. It's this super long-term fixed and fully amortizing debt. And what does that mean for the borrower? Well, and for his investors or her investors, it means increased cash flow, increased IRRs, increased cash-on-cash returns, higher debt service coverage ratios, and lower risk in the case of hiccups because your monthly payment is lower and absolutely predictable for the life of the loan. For 223F debt, these loans are fixed and fully amortizing for 35 years, subject to the remaining economic life of the property. So if you have a building in shambles, it might not be a 223F loan that you want. You actually might be looking for a 221d4 to substantially rehabilitate it. But again, conversation for perhaps another day. Both of these loans will go up to 85% LTV. In the case of 223F, 85% LTV. In the case of 221d4, 85% LTC. LTC being loan to total project cost. The project cost is my price of buying the land, hiring the contractors, buying the materials, building the property, legal, zoning, et cetera, et cetera. So it's a percentage of total cost, whereas LTV is loan to value, value generally being the lesser of the appraised value or the purchase price in the case of a purchase, or the appraised value in the case of a refinance. LTVs will go higher on low-income housing projects and for nonprofits, but I don't think those two items are particularly or necessarily relevant for today's call.
All right, so let me give you some examples. Let's talk about some examples and it's really get people thinking about how they could be applying these. So let's say let's just talk about low-income housing. I got a low-income project, it's an existing project, multifamily, it's 200 doors, it needs a lot of rehab, occupancy is down, and it needs to be stabilized. Is that a candidate for one of these products? Particularly, I guess the 221d4 as a rehabilitation project.
Yeah, if you're pretty well vacant and you're going to do a meaningful rehabilitation project, and there's a lot of caveats about what qualifies, but it could be a great candidate for a 221d4 loan. There's lots of things to consider with 221d4 debt, and that includes that you have to pay Davis-Bacon prevailing wages to your via your general contractor to your workers, and this loosely translates, and I'm putting little air quotes up to like union labor. So it's definitely more expensive, and there's always trade-offs, right? So the other side of that coin is that this HUD insured debt is cheap as hell because it's sold essentially as a guaranteed, as a government guaranteed security. So people buy that up in the secondary market, or institutions buy that up. So the debt is cheap, but there are handoffs, and that's in labor costs and cost to originate. They're more expensive to originate. I know you didn't ask me this, but I'll just wander off topic. And they take a long time. So some of the strengths of HUD debt, you say please, I'm gonna jump into that. So some of the strengths of HUD debt is, look, you've got the highest leverage, non-recourse, lowest interest rate loans out there. The other side of that coin is that they take longer to close, they're more expensive to close, it's certainly more arduous of a process. It's really important that you have a super experienced intermediary or lender holding your hand along the way. And 221d4 debt can take, to kind of put content to context, 221d4 debt can take anywhere from 7 to 10 months to originate. It could take even longer. Now, sometimes that's okay. It coincides with plans and zoning, entitlements, and everything else, but sometimes somebody just wants to close in 90 days. 223F insured debt, I'd put it at right around 150 days to close on average. And there's trade-offs once you start bouncing between that and Fannie, Freddie, and CMBS. Sometimes that 223F debt makes sense. You're handing something down generationally. You want that 35-year fixed rate, fully amortizing, max leverage, lower price debt, and you're not in a rush. It's a beautiful product for that. It's probably the best. But if you're looking to turn something around in a few years, you've got a 5-year hold time, you've got a 60-day purchase contract, 223F debt's probably not for you. I hope that's
yeah. So this is perfect. So that's very good, Blake. So let me take it from there. So I think what you're saying is, so in a lot of instances, you might go in with a non-HUD loan product to do a faster loan origination, a faster closing, get your stabilization done, but you would then refinance out with a HUD program. Is that a fair statement?
You may. I think when you have time to decide, FHA debt is really attractive. When you have a multifamily, so let me restate that. I apologize. So when you have time to decide on a purchase or a refinance and you're not under the gun, it would be irresponsible not to seriously consider 223F debt, period. On the 221D4 side, if you're building a multifamily project and you're not planning, it's not a merchant build, it's not something that you're just going to build and flip really quickly, or you're running into 60% bank loans and you're looking for mezzanine debt or preferred equity, something we could talk about later, or you're sourcing LPs and investors, you'd be amiss not to seriously consider HUD 221D4 insured debt. In these two scenarios, it's a product that should be very seriously considered.
So my takeaway, and this is the way I've always understood it. So really, I think what you're saying, if I can rephrase it, you tell me if I'm on point or not. If you're a long-term play, this is like a generational handoff to your family or to your kids, and that they're going to take over this apartment building and not ever worry about a balloon term. They're just going to live off that cash flow. Then certainly going to one of the FHA products would make a lot of sense in that context. Correct?
Absolutely.
Okay. All right.
Absolutely. So and to punctuate that, and I know we're talking FHA, but I would say that it's a great option. It's not the only option. Fannie Mae is 30-year fixed and fully amortizing debt, and they should be looked at together. Once you have really low-income housing property, maybe it's under a HAP contract, or but if you're doing something that's very affordability focused, FHA will start pushing up leverage higher than the agencies or CMBS can even get close to, and they're going to underwrite a lighter debt service coverage ratio, and that's ultimately going to provide for better loan dollars. So that's another place to seriously consider it. And I apologize if I'm complicating things. It's definitely unintentional. I'm trying to be as
that's the beauty of this. That's the beauty of this, and it's clear you know what you're talking about. So let me play that back again. So if you're doing a low income product, you can raise the ratios, raise the loan to value, which you can be approved for, lower the debt service coverage ratio. I believe you said. Is all that correct?
Yes, sir.
And now which product line was that?
Well,
FHA?
That's anything FHA. Yeah, so that's FHA HUD. It's anything that they're doing. There's always government incentives, especially in and this is quite literally the U.S. government, for subsidizing affordable housing. So Fannie and Freddie both have mandates and both can get super aggressive. But when it comes to filling up that capital stack and getting really high leverage and long-term, really low-cost fixed-rate debt, especially for affordable products, FHA is really, it's a wonderful option. It's an option to be considered by any multifamily investor, developer, owner, operator that's not under the gun for timing. It should always be at least inquired about.
All right, very good. All right, so let's talk about this. So in order to qualify for these products, we talk about, it's non-recourse. So we talk about what the qualifications are to be approved for these loans, if you would, please, Blake.
Yeah. So, lenders paint the picture that qualification is hard and fast, and in some cases it is. And, when you talk about Fannie Mae, like small balance, they'll say net worth greater than the loan amount outside of retirement accounts, liquidity greater than 10% of the loan amount outside of retirement accounts. If it's a refinance, that would be before closing. If it's purchase, it'll be after closing. And sometimes some lenders kind of translate this directly to FHA, but really there is so much that's at the discretion of both the lender and the HUD office, particularly in the case of 221d4 insured debt. So I think a good rule of thumb remains the standard net worth and liquidity like open the kimono, this is how it looks. But you're going to find that different lenders are going to be willing and able to get comfortable with different balance sheets. Now, and different credit scores. Now, the place where HUD, and again, not hard and fast, unfortunately, really loosey-goosey with the rules here, because there aren't any that are exceptionally defined. Experience for HUD 221d4 insured debt. I don't want to talk too much about construction because I don't know that your audience is not very construction focused.
Not really. That's probably we could fall a lot of deaf ears on that one, Blake.
Well, then let me not. Then I'm not going to go down that route. Other than saying that when it comes to 221d4 insured debt for construction, having FHA experience or an FHA experience team is really important.
Okay. All right. But go back to the credit and so I guess let me put it this way. So even though the borrower is not personally guaranteeing, the borrower still needs to show personal credit and needs to be able to show a balance sheet sufficient to satisfy the lender, correct?
Yeah, and this is a question that I used to get asked a lot. I get asked it less often. I don't know if that's because I've done a better job explaining it in video tutorials or on the website, or I'm just being, or if not, I'm just not listening as well as I used to. So the best way for me to describe the requirement of credit and experience and a personal financial statement. And by the way, this is not bank debt. Fannie, Freddie, FHA, nobody cares about your personal tax returns. They want you to file it. They don't want you to cheat. They want you to be honest, but they're not looking at global cash flow. You go to your bank and the bank wants to see that they go right down to the bottom of your tax return, and there's no acknowledgement of the fact that perhaps you're self-employed and you wrote off this, you wrote off that. They don't care. It's a loss. It's a loss. You can't pay your bills. Fannie, Freddie, CMBS, FHA. This is not a factor, other than, of course, like, hey, you better be filing your tax returns, because nobody's okay with not paying Uncle Sam. But I went off topic. I'm sorry. So kind of coming back to the point. In order to qualify for non-recourse debt where the bank says if something goes wrong, we're not going to come after you, you have to be a very qualified person. The only outlier to that is like 60% LTV, hard money, 12% interest rate loan to own lenders who make a loan to you. They'll make the loan to you. If you got a pulse, 60 LTV, you can have the loan because they want to own your property. In the case of Fannie, Freddie, FHA, and CMBS, nobody wants to own the property. They want the property to perform. They want you to pay your bills. And what does that mean? It means they're going to underwrite you and make sure that you have the financial wherewithal to weather the storm. If things go sideways, they need to know that they've got an experienced, financially healthy character steering the ship. John Doe off the side of the street who's sitting on the park bench is not qualified for non-recourse debt unless he hit the lottery or he's just a wealthy man taking a nap. You have to be qualified for non-recourse debt, because I did used to get asked the question, well, shoot, if it doesn't, if it's non-recourse, then why do I have to show this? Why do I have to show that? Because you got to be qualified for it, and there's a pretty high bar.
So okay, so that's great. You covered that point. That's the point I want everyone to hear. Even though it's non-recourse, you still have to qualify for the loan. But if you don't have the qualifications, talk to some about, can you go out and find a partner who does have the qualifications, and what is that process to get qualified with a partner as your, as, say, your co-sponsor as your partner? How does that work out?
Well, you can certainly do that. So the first thing is to make sure that you're actually not qualified. So I think the most important thing here is that if you're seeking financing, particularly above $750,000 for an apartment building, that you have a really well-referenced, really well-qualified financial intermediary. Not, I don't want to discourage lender direct, but I have to, because lenders may push you into the product that works best for them. One lender may not be willing to make an FHA or a HUD loan under $4 million, whereas another one will go down to $750,000. So you really need like an experienced intermediary that can navigate the market, that can look at your balance sheet, can look at your experience, can look at your schedule of real estate owned, and give you a really clear, concise reason of why it's not okay. Okay, so that's really important, because if you go to lender A and they say, nope, you're not qualified, you need a partner, well, maybe you could have gone to lender B and they would have said, oh yeah, we'll do this for you. So that's really important to consider. Now, if you're really not qualified and you want to get another partner in order to qualify, that's fine. And there's lots of ways to go about it. An easier metric to use is Fannie and Freddie, this like net worth greater than the loan amount outside of retirement accounts, and liquidity 10% of the loan amount outside of retirement accounts, because this is really the rule of thumb. This is where people generally fall short. It's a cumulative figure, so it can be cumulative among all the partners. Anybody that's signing the carve-outs, right? Anybody that's signing this non-recourse debt, they get added to that cumulative number. I see a lot of folks that like to hold their property managers accountable and give them a sliver of equity and get them to sign on the debt. That's up to you. So with whomever you share, vet them well, because that's a scary thing. Maybe get them to put some skin in the game, but you can absolutely add people to qualify. I've had people add parents, children. It's totally kosher.
All right, now, perfect. And you're talking about the use of a financial intermediary, so let's make it clear. Let's talk about how people can get a hold of you, then we'll take some questions here. You will serve that role as the financial intermediary on these loans, correct?
That's right. So we are...
Talk about that. Talk about that, please, Blake.
Sure. So, our primary role on the internet is to kind of educate people with everything that's out there. So we have some really, like I explained earlier, some really helpful, informative websites like multifamily.loans, and that's .loans, not .com or .net. It's .loans. So multifamily.loans, HUD.loans. cmbs.loans, commercialrealestate.loans. These are great resources for information. But the other service that we provide is helping folks get that debt and get that right debt. So after underwriting and originating more than $1 billion in loans in my career, and way more than that, and completing multi-million dollar transactions and $50 million equity deals, I know what I'm doing, and I've built a team that I've kind of imparted all my information on, and I stay involved in all the loans from beginning to end. And what we do is we take a look at the deal. You can share your information online with us. If it's a multifamily loan, you can go to get.multifamily, no hyphen, so get.multifamily.loans. And you could put your information on there, and somebody on the team will reach out to you, walk through your options, explain what may or may not work, and take you from beginning to end through the process. I would say a huge, I don't know what the percentage is, let's say more than 30% of our clients are first-time agency borrowers or small balance agency borrowers. They're borrowing between $750,000 and $7.5 million for existing multifamily product. And we are helping them get the highest leverage and the lowest rate at the most reasonable cost and close the fastest, while not treating them like the industry calls them, like small balance borrowers. Treat them like they're institutional clients. Whether it's a $50 million loan or a $5 million loan, we're going to treat you like family. You're not too much like family, because sometimes there's weird dynamics in families. So we're just going to treat you really well. The other thing you could do is you could call our office. Can I plug my phone number too, or is this getting way too self-serving?
Please, absolutely. No, please, Blake, please. They need to get a hold of you to get some help here. Go ahead.
All right. So the phone number you could call is 1-800-567-9631. That's 567-9631. And I'll share with you after the show I've got a short video series that's really, really concise, tight, educational about all these products that we just talked about in really small tidbits. So maybe you could share that in the show notes, and I think people would like that too. And that's it. If you're going out for an FHA, Fannie, Freddie, CMBS loan, you'd be irresponsible not to call us.
I agree. I mean, in this short period of time, and Blake's doing a great job in summarizing what is really a fairly complicated topic. When you different options, different ways you can go with this. And I think everyone heard, you guys are hearing the different ways you can go with it. So the great news is you got Blake as an intermediary, can navigate the trails with you. And plus you got all these great tutorial videos on his website. So make sure you got this down, write this down. Get.multifamily.loans. Get.multifamily.loans. And there's a phone number, 800-567-9631. This is for Blake Janover's companies doing these loans and navigating the trail for you. Hey, I got some questions came in. You up for some questions, Blake?
Oh, Lance, I'm having fun. Let me add one thing. You said it's a lot of information. You said it's a lot of information. To whomever is listening, it can feel overwhelming. What I can give you, the comfort I can give you, hopefully there's some comfort, is even the biggest companies, the biggest multifamily investors, the 10,000, 20,000 unit companies, they hire intermediaries, they hire advisors when it comes time for huge portfolio recapitalizations and buying and refinancing. So nobody expects you to know all of this. It's not reasonable. It's not reasonable to think I'm going to be an excellent top 1% multifamily investor developer. I'm going to be the best in the world at this, and I'm also going to be the best at multifamily capital markets, and I'm also going to be the best GC. It's just not realistic. So for anybody that's feeling overwhelmed, don't worry. If you know your deal and you have a high-level idea of your options, then you're already infinitely more powerful than you were before. And now
exactly right, guys. Yeah, but I mean, to reinforce that. Let the experts do what they do best, and focus on your business. Focus on the next deal. That's why we bring Frank, bring Blake and others here, is so you can hear who these experts are, so you know where to go. Now, speaking of Frank, I see Frank got a question here coming in, and some of these we've already addressed. But I'm going to go ahead and throw it out here again, just in case anyone missed it. So what is the time frame in obtaining a 221B4 loan? We should talk about both the 221 and the 223. Those are long time frames. Can you kind of go over that again real quick, please, Blake?
Yeah, to distill it into some quick numbers, 221D4, that's going smoothly with a super experienced lender will be 7 to 10 months. It can be 24 months, and that's subject to a lot of variables. But I think the most important factor when it comes to timing is who your lender is, because there are some shops out there that are just they don't have the robust infrastructure that others do. So it's very lender sensitive. For 223F, just to revisit, it's about 150 days. So say about 5 months on average from beginning to end for a purchase or refinance 223F loan.
All right. Thank you for that one, Frank. Let's see. Lawrence, a clarification question from Lawrence. Did I hear Blake say that the 223F loans are 35-year amortization with no balloon payment?
Yes, that's what you heard.
That's what you heard. And both of them, for that matter. The 221D, for that matter, too.
221D4 is 40 years fixed and fully amortized.
40 years, no balloon.
And plus another 2 to 3 years interest only fixed during the construction period. So there's no recasting, no balloons. They're fully amortizing loans.
All right, here's a question from Raul, and we actually got a couple in this regard. Is there a U.S. citizenship requirement with these loans for someone to qualify? So Blake, yes,
so
interesting.
I got that question today, and it's not there's not a clear cut answer. You do have to have U.S. based real estate experience, assets. The nuances of residency and visa status would need to be addressed on a case-by-case basis. The simple solve is an experienced U.S. partner. But I think the short answer here is that it's going to be very dependent upon the team, the experience, visa status, social security number, tax returns. There's a long conversation to be had there.
You know, it kind of reminds me. It's like when I ask my attorney a question, and inevitably the answer is it depends.
Yeah, there it is. Well, I'm not an attorney, but with HUD, everything depends. Everything needs a thoughtful look, and it's important to appreciate that every scenario is unique. If you're an investor living in Australia and you don't have a U.S. company or a house in America, you don't file tax returns in America, and you've never built an apartment building in America, then you're so far away from qualified. It's not even a conversation. But if you check off a lot of boxes, there's usually a creative solution.
Yeah, I agree with that. Remember, I've been involved with some transactions where I had a Canadian investor who was able to get qualified under all the conditions that Blake was just sharing. So, the real takeaway is for Raul and anyone that, thinks they're have this concern, contact Blake. We got a project, get a hold of Blake and let the intermediary help you navigate. Yeah. Just find out what the situation is, because there's all kind of options out there. I got a number of requests. Let me repeat here how to get a hold of you, Blake. Let me just say it again. And by the way, I'll put these on the show notes, but we give you the web page and the phone number. Web page is get.multifamily.loans. Get.multifamily.loans. Phone number is 800-567-9631. And the replay will go up on the, let me say this real quick, the archive page at greenlightreinvesting.com. Greenlightreinvesting.com. Go ahead, Blake, you were ready to intervene there.
Yeah, people can also email my team. We're available at hello@multifamily.loans. So it's HELLO@multifamily, MULTIFAMILY.loans, no .coms or .nets. If you want to learn more about our parent company, which is Janover Ventures, which owns and operates all of our websites, that's www.janover.ventures. There's, again, no .coms or .nets. It's just janover.ventures. And you can learn more about us there. And again, I'll share my LinkedIn, and I don't have a Twitter, but I'll share everything with Lance post-show, so that it can be delivered on the show notes.
Perfect. So you got multiple ways to get a hold of Blake's team here and get you started. Now, I got one more question I'm going to ask here, and then we're going to wind down. This is a question. This came from Sam, and I'm not sure we even talked about this, Blake. We may have, but the question is: are these loans we've been talking about today, are they assumable?
Yes, most non-recourse debt is assumable. So Fannie, Freddie, CMBS, FHA, many life insurance company loans, they're all generally assumable for a nominal fee and some light underwriting on the new principal. So that's a yes. It's a way to avoid prepayment penalties, which is something we also didn't talk about, but we can save that for another show.
Well, and I would definitely want to invite you back, because this is fascinating. I got to add one more thing to assumable loans. So let's say you've got your HUD 223 loan in place with a current market rate that's low, certainly compared to lifetime standards, and you're down the road and inflation kicks in and the market rates have gone up. Of course, you're locked in with a fixed rate for that 35-year term. What does that do to the value of your building if you decided to sell your buildings, Blake?
Well, the question feels rhetorical, but let's go with it. I think that there's a trade-off there. So it's not all it's not all roses and rainbows, or I don't know what all the good things are, sugar and spice. There's obviously, it adds tremendous value if you have a lower interest rate than what market interest rates are. If your property is appreciated tremendously, it also leaves you in a situation where the buyer has to come with a fairly specific amount of down payment. So there's two sides to that coin. If you've got a great buyer who's flush with cash, or they got 1031 money, and they're going to put it into a few deals, it's great. It's going to set your property apart from the market, but it's also going to narrow your buyer's pool. So you'll be much more attractive to more specific buyers, and perhaps a little less attractive to buyers that maybe like some of you guys that want to come in and lever up. Now there's a catch to that. So Fannie, for example, not that we're talking about Fannie Mae, but I bring it up because we're talking about small apartment loans. Fannie Mae has a great product, which is their supplemental loan. And that's really cool, because what happens is, if you've got like a 30-year fixed low rate, I think we just did a 15-year fixed loan at like 4.11%. It's crazy. But if you've got this really low rate loan and you've created this gap of how much money somebody has to put down. Maybe they have to put down 30 or 40%. Fannie has a supplemental loan, which a new buyer could come in, assume the senior debt, assume the existing debt, and put a supplemental loan from Fannie Mae on top of it, which would be coterminous with the first. So if there's 5 years, 10 years, 15 years, 20 years remaining, the supplemental loan from Fannie Mae would sit on top of it, and that would get you up to 80% of the capital stack. On a HUD 223F loan, it's absolutely assumable. Supplemental products for FHA are a little more complicated and nuanced, but that's to answer your question, Lance. I'm so long-winded. I'm sorry.
No, it's perfect. It's perfect. It's perfect, Blake, because you just open up a whole nother next podcast, because I didn't even realize that. So you can put a second FHA to pull out, cash out some of your equity. Oh, that's beautiful. That's beautiful. All right, everybody, guys, let me give you this. So let me give you this information for Blake and his companies. This is a person you definitely want on your team, on your power team. So I got 3 things here. First of all, his webpage, get.multifamily.loans, get.multifamily.loans. Phone number 800-567-9631. Email to his team is hello@multifamily.loans. Hello@multifamily.loans. I will post this on the show notes. And of course, those show notes and the replay of this great session are at greenlightreinvesting.com, greenlightreinvesting.com. And when you go there, you're going to get not only these show notes, but access to a lot of other great tools, a lot of great free resources. Make sure you're plugged into that archive page. Hey, Blake, man, this has been fantastic. I really, really appreciate, first of all, what you've invested into the industry to be able to understand this and convey it in such simple terms. And it's great service you're providing to people as their intermediaries. So great job. Congratulations. And thank you for all the information.
Thank you for having me, Lance. I really had a lot of fun. I hope you'll let me do this again sometime soon.
Oh, you bet on it, man. You bet on it. We're gonna squeeze your brain, man. So all right, everyone. It's Lance Edwards. Thanks for joining us today. And Greenlight REI, remember to make your lifestyle a real estate successful one. Take care, everyone. Till next time. So long. Bye-bye.
Thanks, guys. Bye.